Protective puts are most effective in uncertain or bearish market conditions where there is a risk of a significant decline in stock prices. This strategy is particularly useful for investors who want to retain their stock positions but are concerned about potential short-term downside risks. It may be less necessary in stable or strongly bullish markets where the likelihood of a significant drop in stock value is lower. What is the risk profile for a protective put strategy? The risk profile for a protective put strategy involves limiting downside risk with an added cost. While the strategy provides downside protection, the cost of purchasing the put options, otherwise known as the premium, is a guaranteed expense, reducing the overall profitability of the stock investment. The key risk associated with a protective put strategy is the cost of purchasing the puts, which can reduce the overall return on the stock investment. However, this strategy effectively limits the downside risk, as the put option sets a floor on the potential losses from the stock. The maximum loss is limited to the cost of the put option plus any decrease in the stock value up to the strike price. What are the potential rewards of using a protective put? The potential rewards of using a protective put include protection against losses with limited impact on gains. The strategy allows investors to retain the upside potential of their stock position while capping the downside risk, ensuring that losses do not exceed a certain level. The primary benefit of a protective put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rises and the put option expires worthless, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the considerations for implementing a protective put strategy in stock options trading? Key considerations for implementing a protective put strategy include choosing the right strike price and expiration date for the put options, balancing the cost of the puts against the level of protection desired, and timing the purchase of the puts to optimize cost effectiveness. It's important to align the protective puts with the investor's risk tolerance and market outlook. Implementing a protective put strategy involves owning or purchasing a stock that the investor wishes to protect, identifying the appropriate put option to purchase, typically with a strike price at or below the current stock price, considering the expiration date of the put option, aligning it with the period during which protection is desired, purchasing the put option, paying the premium required, monitoring the stock and the put option, especially as the expiration date approaches or if market conditions change, deciding whether to exercise the put option if the stock price falls below the strike price or to let it expire if the stock price remains stable or increases. A protective put strategy in stock options trading requires a careful balance between the cost of protection and the desired level of risk management. It is a prudent strategy for investors who seek to mitigate downside risk while maintaining the potential for upside gains in their stock holdings.